Good morning class. Today we are starting our new module of financial accounting, and financial accounting may have different names in different programs such as bookkeeping or financial accounting or accounting 1, but it is the same course with different names and different modules. Now accounting, in fact what we do in accounting is general concept that we have records, we sort them, we organize them, and we record them in a meaningful way to present to the shareholders or the stakeholder in such a way that makes sense to them. And there are 2 or 3 statements that we produce at the end of the year, which is called financial statements. In financial statements there are income statement and there is a balance sheet, and there is a statement of equity or cash flow as well. But generally speaking, we will be dealing with 2 things. As many of you may not have any exposure to accounting, I would like to explain you a little bit in details and very common way. So when we say income statement, actually all the accounts in the income statements are temporary accounts. Why I say to temporary accounts? Because at the end of the year either we have a gain or loss, alright, so that we record, and at the next year all those accounts will start from 0 again. Now on the other side we can say that income statement is for a specific period, generally for 1 year. Sometime we do in between interim statements, which is maybe 6 months, and usually it is for 9 months. Now what it tells us in generally, the income statement tells us performance of the company, whether the company made losses or gain. You know, the definition of the business is any entity which is for the intention to make a profit is actually a business activity, alright, because they are not non-profit organizations. I don't want to go into details of non-profit or profit organization at this point of time, but any activity with the hope of making a profit is called business. So in the income statement what we do actually, that we will know actually that how much profit we made at the end of the year. So to know that, what term we can use is tells us the performance of a company, alright. And on the other side, the balance sheet. Balance sheet will be mentioning or explaining to us the status of a company as a particular point of time. So in this case when we talk about income statement, it tells us period for 9 months, 6 months. But in terms of balance sheet, it will give a status of our company, how much assets we have, how much equity we have, how much liabilities we have, and it will tell a specific point of time. So usually when we write basically present financial statement, in the income statement we tell for the period of 12 months from January to December 31st. But in terms of balance sheet we will always tell as of December 31st 2000 what. So specific time, because as the transaction change, every transaction will change the status of the company. Either asset will increase or decrease or equity, alright. So on the other side, just to make it more comfortable, all the accounts related to income statements are called temporary accounts. Why temporary accounts? Because we will use them for 1 year. At the end we will combine all the revenue items and minus all the expense items for that period of time. If there is a profit, that will go to the balance sheet in terms of increasing the equity if it is a sole proprietorship like one man show, his own company, or if it is a corporation it will go to the retained earning. We are not going to go into details of that, but later on when we will doing the formation of the companies we will be discussing them as in details. On the other side, the balance sheet will tell us as a specific time what are the assets and what are the liabilities. Now just we will be going through a lot of examples later on, but why we call this balance sheet? Because it is a balance on a sheet, alright, left or right or up or down. So one side is assets and the other side is liabilities. For your general information, liabilities are of 2 types. One are those liabilities which are the owners, okay, which is called equities, like the owners give money and invested money in the company. On the other side, sometimes we borrow money from the outsides, alright, those are called liabilities. So liabilities plus equities, both are the responsibility of the business or the company to pay off, but usually we pay others first, then we ourselves, okay. Any gain or profit will go to either increase the equity or decrease the equity, alright. So if there is a loss, what will happen? The shareholder, the owner of the business will consume that. If there is a profit, his share will be increased, okay. So generally producing these two statements, income statement and balance sheet, and rest of stuff is like cash flow statement, that's in detail we will be covering by this point of time. I just want to let you guys know we will be dealing with income statement which are temporary accounts, which are always for a specific period, which tell us at the end gain and loss. All the items, all the accounts related to income statement at the end of the year or the period will become zero, and the next year the opening balance of all income statements are zero. This is a very good intro questions. Sometimes we do ask what happened to income state item the next year. So if we have a $10,000 expense of the advertisement, next year we spend $2,000, we ask no, it should be 12,000, and many times people say yes, 12,000. But the answer should be at the beginning of the year all the balances become zero. So if there are $2,000 they are spending on the advertisement, that is for that year. Now there is a lot of gap analysis, the GAT analysis. I don't want to go into detail at this point of time. In simple format, as we are building a little bit concept of accounting course, that the income of this year will always be offset by the expense of this year. Like what we will do, if we have put some advertisement this year and we got the sale this year, right, that should be considered in same year, not in the next year. That is called the matching principle according to our GAAP, General Accepted Principles of Accounting. So you guys are okay with that? So that's why whenever you read balance sheet, you will say as of. Whenever you will read income statement, for the period of. If I ask you what are the temporary accounts, income statement has a temporary account. What are the permanent account? The balance sheet account. So that's why whenever we check the performance of the company, what we will do? We will look into the income statement. When we see what is the status of the company, we want to buy a company. A company may have a $2 million assets, but we have to look into how much are the liabilities, how much is the owner's equities, okay. So that is the basic concept. Now from there onward, there are certain things, and I expect everyone to learn something more, okay. Now there is a word called debit and credits. These are very confusing words, alright. Sometime in my experience, many people who even have developed those softwares, okay, they have finished and we are using those software. If you ask them what is the difference between debit and credit, they will not know. They will always ask, what should we put on the left side? What should we put on the right side? Okay? But we have to learn it. Now, frankly speaking, accounting is so simple. It used to be very difficult. People were scared about it when there was a manual accounting. But there are a lot of things we have to do, and there were a lot of transposition errors. Now, many of you may have some exposure to manual bookkeeping, and those terms may be familiar to you, carry forward and brought forward, alright. So whenever we carry forward or brought forward, what happens? There is a error chances of transpositions, okay. So then there are a lot of T accounts and trial balance, adjusted balance, and the balance sheet, income statement. Now things change. Frankly speaking, now these are the form that you will be using. You enter the data on one side, the other side computer will take care of that. Now I will let you know, I will give you a few 3 code words which you will write anywhere and accounting is done. And these are the things they put in the brain of the computer, okay. The only thing you are required to do is to look into what happened, which means the analysis of the transactions. Like you buy something, what happened? You know, buy something, your asset is increased. You sell something, your asset is decrease. You pay cash to someone, what happen? Your asset is decrease. But we will classify generally what are the main items of that. Alright. In assets we can say the cash is an asset, account receivable is an asset. Inventory, what is inventory actually? You know, I usually ask this question, if someone has his own car and he also has a dealership for the cars. So anything you buy for the purpose of selling it to the customer is called inventory. So inventory is also considered as an asset. Like if you have a 10 or 15 cars to sell, it means that is your assets, right? Now on the other side, there are different classification of assets. These are called current assets, okay? And then there are fixed assets or long-term assets such as building, machinery, equipment. On the other side we have the liabilities. What are the liabilities? The money that we pay to outsiders. And in the term of accounting we will be using accounts payable, okay? And sometime when we start the business, the owners put lot of money into the start of the business, that is called his equities. He has a claim on those assets. Now for sure there would be some new terminology that will be introduced you to in the due course of time, and I'll take you to the examples, but I will depict some of the presentation to you guys. As I mentioned that I will give you a small rules which you will follow. The only job that you may have is to analyze the transactions. Alright. So let's go for the rule. The rule is, if the assets increase, debit it, and if assets decrease, credit it. Now as we will be dealing with a double entry, you don't have to remember the other side. If you know one side is debit, the ultimate other side will be credit. So let's understand this. If assets increase, we have to debit it, right? Now how we write debit? We always write debit as a left line, and credit we put a little bit tab to the right side, like generally indenting, right? Again, these things were needed when we were doing a lot of manual entries, but as of now still you will be doing some of the entries before you will enter into the system, and those are called adjusting entries. You will be sitting with the auditors and those kind of stuff. So let's go back to our narration, that if asset increase, what we have to do it? Debit it, right? If asset decrease, credit it. Let's have an example that the owner of the business put $12,000 into a new business. Let's understand what happened. Okay, $10,000 is belong to cash. Cash is an asset, okay? Where it goes? It goes to the business, right? So if we have a business, okay, and that business received $10,000, what happened? Assets increase in the business. There was zero assets, now it's 10,000. So when the asset increase, follow the rules. Rule says, what says on the whiteboard? Debit it. So write down cash debit by $10,000. Now what happened? Who paid that cash? The owners. Okay. So owner's account has to be credited, okay, because we know one is debit, the other is credit, even though I didn't tell you the rule for the other side of it, but forget this point of time, okay. So in this case just go back to the rule and please write down on your notebooks this: assets, expense, withdrawals. If it increased, debit it, and if it decreased, credit it. Alright. So it means you have to remember AEW. Make an arrow upward. If that is the case, debit it, and otherwise credit it. On the other side, what you have to do? Liabilities, incomes, alright, or equity which increased, credit it. It is the reverse. So again, income, liabilities and equities increase, credit it. You know, in the first example as we mentioned, the assets increase, what the rule says? debited. So cash was debited by $10,000. On the other side, whose equity was increased? Owner who put $10,000. Remember, this is a liability, but the liability to the outsider is called accounts payable, and liability to the owners of the business is called equity. As we mentioned, both have the same treatment. By putting $10,000 into the business, what happened? Equity of the owner is increased. So if equity increase, what we have to do? Credit it. Okay? So now you are not using your mind at all. Simply follow this rule. So what is the objective over here? Just to analyze the transaction, nothing else. Rest of stuff, this dumb machine will do it for you, because this formula is already placed there. Okay? Now as we will be going through, I will be explaining the items or accounts related to income statement. In the income statement, generally on the upside we have revenues. Revenues could be from one to source, or on the, and then there is an expenses. So general formula, revenue minus expenses is called gross profit. If you want to know what is the gross profit, what is the revenue you have minus what is your expense. Now that is the general expense, but there are other expenses, alright. Basically when we say revenue, that is the price or the sale price of the things that we sell, and then the cost. So sales minus the cost is our gross profit. Now to do that business, what we have to do? We have to do advertisement, we have to have a labor cost, we may have to have electricity, we have a rent. If we take out those kind of things, it will become net profit. So again back, income statement, temporary account. At the start of the calendar year, what happened? It will start from the zero onward. At the end, it will conclude either profit or loss. Where it will go? It will go to the balance sheet. Either it is in the equity or into the retained earning in case of corporation. Forget about the concept of retained earning at this point of time, but we will talk about later. Alright. So that is this clear to you guys? Alright. So this is basically it. Okay. We will follow an example, few transactions, and then you will know more. What I did actually, I just explained you the journal. So basically sometime when you got a bookkeeping or accounting job, you got a box of invoices, what do? You will sort them, organize them according to the month or according to the vendors or the expense nature, and what you will do? You will enter into the systems. Okay? Once you enter the transaction, in this case in manual accounting you have to do a lot of processes. Here you enter the transaction and everything will be completed till to the income statement and balance sheet and owner's equities. Now what we have to understand, that we have to know the nature, how the information flow from one part to another. If we made a mistakes, how to correct it, right? Say for example, when I started my article clerk, and it's a very stupid question that I asked to my manager, that always I will prepare trial balance, income statement, a balance sheet, and the guy will sit to the owner of the business, and the owner of the business will say, I don't want to pay that much of profit, okay, and taxes and stuff like that. So he will say, okay Mr. Shikuri, just increase account receivable, alright, sales increase and account receivable. So he will tell me change here and there, and one day I ask him, how do you know when you change on one page and the other changes on the fourth page? Which means that if you have to increase the sales, sales belong to income statement, account receivable belong to balance sheet, right? Now we know, and the answer was very simple, that one day you will know why it is happening. Okay, so that's all about, and let's do have a little bit break, and then we will go and do the transactions, then you will understand better. Alright, thank you.